The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, traders. Thanks for joining us here. It is 3:30 p.m. Chicago time on Wednesday, the 18th of August, 2021. I'm very excited about what we're going to talk about today in this Convergent Trader Spotlight. We're going to have Kelly Farrell on with Diamond Capital Management. We'll have a face-to-face discussion with her about all that goes into managing a fund, especially one that trades our favorite product, the S&P 500, the micros, and also crude and so on in some of our programs. So I want to remind everybody that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Remember that the opinions shared here are those of the person providing them. They don't reflect either Kelly or my or Convergent's opinions. Do your due diligence before you trade any ideas you get from this discussion. What we're going to focus today, we're going to just briefly talk about Kelly's background. How did she come to run a fund? We're going to discuss her perspective on the futures fund industry. How's that going? We're going to talk about a fund manager's approach to strategy development. So we're going to discuss a little bit, without getting too much into the secret sauce, what it takes to develop a strategy and to manage it over time. And then we're going to talk about risk management. From the viewpoint of a fund, how do you keep yourself hedged? How do you keep exposure on money that you're managing for other people in check? Issues relating to trade execution. How do you execute when you're deploying potentially large positions into the market? How do you get in? How do you get out? Issues relating to trade execution, that's what that is. Maintaining a sustainable mindset. How do we do this without, as a professional, Kelly's done this for a long time. How do you do this without burning out? So without further ado, let's bring Kelly on. Kelly, a quick mic check.
Hi there.
Hi, I forgot to turn on my camera. Kelly, you can go ahead and turn yours on if you recall how to do that.
Yep, give me 1 sec here. Okay.
Hey, good to have you on. Okay, Kelly, so what we want to talk about, just a brief description of what your journey has been. I know that you got involved around late 2001, 2002, somewhere in that range. You've been doing this for about 20 years. How did you get to a point where you're participating or managing a fund?
So I initially was working for a bank, doing some fixed income trading, managing a broker-dealer trading desk, and worked with someone who had been in the CTA space, and I was interested in the options, and decided that that was something I wanted to do further, and we developed a options-only trading strategy, and that's what we launched with Diamond. And we were trading the big S&P, so back in 01, 02, the index was much lower, and we're able to trade those large contracts today. because of where the index is, we're using micros and minis. So you just have to kind of adjust as you go along. Did that, basically it was a premium selling program. It did very well. But then we hit the big volatility in 08. And I just really wanted something that had more balance. So was looking for a trend following program or something like that. And one of the guys that I was doing some other things with, said, hey, I have this trend following program. What do you think about working with me on it? And it was perfect timing. So I said, well, I was thinking about, using it with the options. So we came up with our program. And we've been trading the enhanced S&P. So basically it's a long-term trend following program that has a trend reversal, mean reversion component, and it then has an option overlay. So
okay, so would you say that you're, if you take a position in futures in a trend, you're constantly hedging that position with options, or is options a supplement to whatever returns you can get out of the futures position?
So the options portion of the program is just an enhancement of performance. So it's just an add-on, add a little bit extra performance. We're selling, front month puts, calls if it meets our risk reward parameters. So that has its own set of, risk parameters and leverage that we apply. And then it's just on top of the trend following. However, we will use options when we might get a signal that's opposed to our current position in the futures. We might use options as a hedge, like, using a long put spread type of a thing, or we'll even, sometimes ratio it out and do like short call, short put underneath, long put in front, just to pay for it because you're paying for insurance.
Mm-hmm.
So those are, some of the strategies that we use options for, but then that's more associated with the other part of the program.
And that other part of the program is much more in our playground, which is day trading. You have a day trading portion of this. Can you describe that a little bit?
So we have two programs. So the enhanced S&P is the one I just described, and then we also have, for further enhancement, Diamond Enhanced Solutions, which takes everything that we're doing in the enhanced S&P program, and then it also has a day trading component, which can trade in silver, gold, crude, or the micro S&P. And then those trades are just short intraday trades. We don't have overnight exposure. We're just looking to grab small amounts, and the target is, pick up somewhere around 5%, in addition to the performance that we get from the enhanced S&P.
That 5% is describing a rate of return on an annual basis.
Yes, an annual basis, right.
Okay. And can you give us an idea on the day trading portion of the program? Is that also trading momentum based, or is it a mean reversion type of idea, or how do you look at the market when it comes to day trading?
That's more of a momentum based type trade, and then we're just looking for the market to push through kind of to an exhaustion point almost, and then we're just taking our profit off and exiting, and then we have tight stops based on various parameters that we're looking at, should it go against us. So what we're really trying to achieve there is, somewhere around over 50% profitability rate on our trades, and that the profitable trades exceed the losing trades.
Okay. In general, and we'll talk about strategy in a bit. I have a very specific question there to ask. Let's just switch gears for a minute, because I wanted to, just as a fund manager, you have part of your job is to solicit funds, to talk to prospective clients, investors, people like that. What is your perspective on the futures industry? Specifically, how are the index funds and robo-advisors impacting your ability to attract capital into what you're doing? How has that changed over the last maybe 5 or 10 years?
Sure. So, just like for an example, when we first rolled out the option trading program, we didn't really have to do a lot of marketing. Our performance just spoke for itself, and we had our information posted on various websites, and we attracted a fair amount of business. Kind of after 2008, I think that it's become a little bit more difficult, and the playing field has become larger. There are more options to choose from. And right now, with the markets moving the way that they've been moving, I think that it's made it a little bit more difficult than it had been before in terms of raising assets.
And by saying that there are many more options, this is the introduction of the weekly options expiring Fridays, the Wednesday options, the weekly Wednesday options, or is there something else?
No, I'm really talking about different investment options.
Oh, so, investment options.
ETFs, different futures funds, there are just so many more potential opportunities for clients to look at depending on what their style is or their preference.
Okay. Where do you see this all going over the next 10 years? Do you believe that the complexity continues, or do you see better opportunities over time, or how do you see things going over the next, let's call it 10 years?
Right. I think, we see things kind of move in cycles. So, I think that there are some very good potential markets and opportunities for us to, achieve growth both in performance and with our assets. A lot of times, when the stock market itself is more difficult, we find that more people are looking for a managed opportunity, and we see, a lot more growth come at those times. But I do think that we have to be aware of some of the changes too, like with the onset of, like you were saying, robo trading and whatnot, we've experienced a lot more volatility in fast moving markets. If you just look at the markets since, the beginning of 2018, for example, we've just had some very big moves in between there. Yes, we've been in a nice uptrend, but in between there, we've experienced some big volatility. And much more, the volatility happens much quicker. A lot of times it has a lot more depth. If you just take like February of 18 or 2020, for an example, we went from being in a bull market to a bear market in a matter of weeks.
Back to a bull market in a matter of a couple of months.
Hard to capture that, especially, like when you're in a typical trend following program, you're following the trend. When the trend reverses or starts to evaporate, you move out and you wait for the confirmation of a reversal on the trend. Well, that all just happened in the blink of an eye. So those are some things.
You might want to have a look at crypto if you think futures are fast. Those things can really turn, and they can turn hard to the tune of 8, 10, 15% in a matter of an hour. So, okay, very cool. Thanks for that perspective. So let's talk about strategy. Mm-hmm. And this from the perspective of what do you trade? You've described that as the enhanced program, which is the longer term swing type program. It's mainly S&Ps, S&P options. And then the other program, which is short term, day trading, no overnight position program in the micro ES, crude and gold is what you mentioned, right?
And silver, right?
And silver, and there's no option trading on the day trading program, of course, because it's tough to get in and out of options on that short time frame, right? So that's what that's what you trade. In general, what is the time frame in which you trade in the enhanced program, in the longer swing program? What kind of a holding period are you looking at in general per trade?
So for the enhanced S&P portion, which is the long-term trend following, we're just following the trend. We could be in a position for months, basically roll over with the quarterly roll. But then with that, we have a trend reversal, mean reversion type of overlay on that. So there are basically 3 systems in that program that are non-correlated that work together. So that mean reversion trend reversal component can either give us a signal that's going against, it can give us like a sell warning, and we're long, and it gives us different strengths of signal. So there can be a little discretion in there. How do we react to that? And if we have mid to stronger type of a signal, we can use options to hedge, like a long option spread type of thing, or we can actually exit and then wait for either the trend to resume, or in like the instance of, a clear instance in 2008 where you get a reversal and you end up going short and then capturing that run. So we kind of look at the trend reversal program as keeping us nimble in between while we ride the trend. The trend is never going to pick the top or the bottom. We're just looking for, confirmations that we're continuing in a trend. And then when a trend starts to turn, we're looking for a confirmation that the trend is actually turned. And then within that, there are various risk parameters built in and filters that we use for our exit strategy as well.
Okay, so this next question is not looking for details on your 3 strategies or systems that you're running, but consider that you lost all your data and you lost all your programming and you need to start over. As someone who has run a fund with 20 years of experience, how do you put a strategy together that is big enough or robust enough for other people to invest into? What does that process look like?
Well,
I know that's a big question.
Yeah. I think in terms of strategy, you have to know your personality type. I think every trader has a different type of personality, and different time frames work for certain people. Like certain people like a fast moving market, they like to be in and out, know what their profitability or not is. Others, are looking for the long term. They have the patience. They don't want to be like constantly analyzing the market, in every minute or 5-minute bar or whatever it might be. So you might be looking for more of a intraday type of a product. So you have to kind of figure out what works with your personality. And then, of course, there are certain parameters or there are certain indicators that I've grown accustomed to that you know work, and then you have to start your testing process. So so when we developed the enhanced solutions, we did several back tests on that based on the various parameters that we developed, and then with all the volatility that came in 2020, we had to adjust again to accommodate for volatility. So you're testing, you're running your parameters, you've seen what works best, and then you kind of move forward with that. But the key there is once you develop your strategy and you have to define what your risk parameters are, how much of a loss are you willing to take? Are you looking at your overall portfolio with all your trades? What are your parameters with each type of trade? And then you have to have your set rules. And it's really important to stick to your rules. So when you've defined what your risk is, and then you put parameters in place to trade upon those rules, you have to have the discipline to do that. It's when you second guess your rules, when you find something that's working, that you can get into trouble.
Or make adjustments while a position is open.
Right. Right.
Because you think you might have seen something extra, which we always seem to see something extra as soon as we open a position.
Right. And then,
So,
you just can't do that when you're trading a client's money, so that's why you have to develop your strategy, develop your rules, develop your risk parameters, and then you have to abide by those. Now, you also have to test, so in the time I've been doing this, we've had, a lot of different market environments. We've had 01, 02, which was a pretty steady drop, with the volatility that happened in 08, 2020, as you live through these environments, and then as the index has, gone from in the hundreds to now, like heading up over 45 at some point, you have to make adjustments. So, what is our leverage, and how are we positioning according to, our risk? So there's a lot of moving parts, and you just have to make sure that you know what they are, and you have to abide by them. Now, with some of it, you can actually program it, but you have to keep testing, I think, test environments. So in certain environments, I can remember saying, oh, maybe we should look at this from the perspective of maybe a little bit shorter time frame. And then we went back and we tested it over the years. And it was like, oh, that really didn't improve performance. So stick with what we have. So, you're kind of looking back and trying different things as environments change. And then if you need to adjust, as we have done over the years, like I said, we went from using the regular size options. Now we're using minis and even micros. You just have to be aware of what's happening and know when it's right to change.
got it. So, with that being said, how do you get an understanding of whether or not your approach is going to be robust? So you've tested the past, the future is unpredictable. Every single trade has a random outcome. This may lose, this may win, following the exact same rules, the exact same setups. How do I make sure as a trader that my approach is actually robust enough to handle the changes in the volatility, the changes in the behavior, maybe a mean reversion market turns into a trending market or vice versa? How do you account for that?
So, you have to make sure that, risk is always a priority, right? So you want to make sure that you know what you're risking and how you're doing that. But you also have to be able to know when to let trades go far enough so you're actually achieving profitability, right? And so when we created this, like for us, we looked at, in terms of the trend following, markets are typically trending up. So there's a long bias to the trend following system. But then how do we navigate when we have the volatility that come in? And what do we need to do? So we looked at, we move leverage. So we can scale leverage up and down, kind of a thing. So that way, as our indicators, show us that volatility is coming into the market, we might be hitting a point for a reversal type of a thing. Then, we have the different strategies that we use that would basically, help us control risk, I said with using the options and whatnot, but also scaling leverage up and down. So position sizing, in terms of the options, how far out you might take an option, how far out of the money is the option. So you're looking at all the different factors that go into that. What is price? What is price telling us? So we see this, expansion in price in an option for a strike that we, feel is sufficiently out of the market based on other parameters, where price is telling us we might want to, we should probably push that further out. So there's, you have a lot of different moving parts that you're looking at, and you want to make sure that you are profitable more often than you're not. And
Okay.
have sufficient risk built in there that you aren't giving up everything that you make.
I don't know if you know this term R factor, and it's simply, are you familiar with this term, R factor?
Yeah.
It's the rate of return on risk, but it's not a profit factor like a fund would have. It's
Right.
individualistic to a trade.
Okay.
So essentially, one of the parameters that might filter out a bunch of trades might be, I will only trade if I can get an R factor of 1.5, or what we call 1.5 R. So I need to be able to have room in profitability on this particular trade that gives me 1.5 times the risk.
Mm-hmm.
Is that something that matters to you? In my experience, I've been doing this also 20 years, moving on to 21 this year. You can do all kinds of things and get really fancy with trading, but the easiest way, in my opinion, to improve overall performance is to just improve your R factor, is just to not go for trades that are one R. I'm going to lose as much as I could gain, and therefore I need to be 80% or better over a large number of trades to even see a return after costs. Do you have a parameter that is similar to that filters things out?
Like our risk reward parameter, I guess.
Yeah, that's what it is.
That's really what we call it. So sure, and especially like when you're looking at the options, right? So that's why we don't do calls all the time, for instance. So you're just not getting enough premium far enough out of the money, given the time, volatility, all of that. If you're not picking up enough premium, it's not worth the potential risk to take that trade. And the same thing on the put side. If you have to make sure that your profit potential is such that you're picking up enough premium that the trade makes sense, but also that the risk that you're taking is also that you can navigate that risk. So in other words, like when we do like selling the puts, we're far enough out that we give ourselves room that we can adjust and do whatever strategies that we have in there depending on what happens, so that we can navigate that position and not take undue risk. And then position sizing is all part of that as well. And then we look at each of the positions that we have on in the strategies, and then how does the risk reward profile look on the whole portfolio as well. So we have parameters with each trade, with each system, and then we look at the whole.
Got it. Sounds exhausting. How do you care about the S&P at these all-time highs? What is it? What's your opinion of the trade as the market makes new all-time highs every week? How does that come across to you as a fund manager?
It's basically with the trend following. We're riding the trend until the trend is no longer moving in the direction that we are riding. So, we get that question all the time, like especially in the last year. Oh, we're hitting new highs. This is we're due for a big drop and all that. Well, we're just riding the trend, and the trend lines, and support hasn't really been broken. So we just continue with the trend. Now, with that said, we have, made adjustments to leverage so that we can navigate when that turn happens. So, we're actually right now at a slightly lower leverage than a one-to-one leverage. So yeah, we can adjust for that, but we're making small adjustments, and then we're using our different signals to tell us when it's time to do something protective. So like right now, we had like a sell warning, and we have on a long put spread that we've had on for a little bit here.
So you're actually jumping into the next question, which is awesome, because yesterday we sold off in the S&Ps. Okay, we opened in a gap down, we ran down to 44.11 or so, and then we ended up rallying back to 44.45. And then here we are today, below 4,400. So the first question is, when did you get that warning? Is it a warning that's a response to what happened yesterday and therefore you have to make the adjustment today on the open, or is it ahead of it, or how does that work?
I actually had it on for a couple of weeks.
Oh, okay.
So we had a warning. It didn't really go away. Remember, we're looking at the longer term trend and potential reversals. And we actually had to roll it out into a further expiration. But as the signal had not gone away, you continue with the position. And so now we have it on now when we need it. That's been a difficult, the shorter term, like reversal warnings, are a little bit more difficult in this environment where we have these, super low rates and there's the fear of missing out. Not that that's part of our strategy, but what you see, like we get these pullbacks or small corrections, and then they're buying it up right away because people are more afraid of missing the opportunity than they are of taking risk.
Yeah, than the risk of loss. That's right. Very cool. What would you need to see in order to add another product to your strategy? Why not spice things up, as we say, with some NQ, something that has, 240 points of range every day or whatever.
There you go.
Are you just like, hey, I'm great with my hammer, I'm a carpenter, and I'm just perfecting this hammer? Or do I pick up, a drill and become somebody else? At what point should a trader in your position start looking at diversifying versus being in a product? And this is on the enhanced swing program, which is your kind of the big piece in your fund. When do you look at other products?
So, originally we're in the enhanced S&P or in the S&P because it's got huge liquidity, right? So it gives us opportunity to grow in the options. We've got depth of strikes. I don't have an issue when I want to get out of a trade in some kind of volatile market. The market is going to be there for us. It's even become so much more liquid that we can trade in the overnight markets on occasion, depending on what's going on, and not be completely negatively impacted by spreads. So, we're looking for, a very liquid market, and it's a broad-based market. So we just chose the market that represents the biggest portion of the equities and was a little bit smoothed out as compared to perhaps the NASDAQ. And so stick with what you know and what's working until it's not.
Very cool. I want to ask you, before we move on to the next segment, what was the best trade that you've ever put on?
The best trade?
How did it do? Yeah.
These are longer term trades. So, we're riding them for a long time. So when you're catching a nice trend, that's always great. But, from time to time, from my options experience, you catch a premium pop. Like how, I like to look at it as your best opportunities are when, you've got premium pushing up, you're able to get really far out of the money, pick up, an option that's well out of the range of where you think the market will go in the time frame that you're using it. And then it just it's smooth, it just goes, and you have no pressure whatsoever during the course of that option's life, until it expires. Those are really nice when you can just, pick up a nice pop and premium and just ride it.
When you describe a pop and premium and riding that out, this must be a premium selling opportunity, right? You're picking up a lot of premium and you're watching it get worthless
Right.
in a very smooth way, you know,
Right. Time
theta
is your
burn or
friend.
whatever. Yeah.
When you're short on the options, time is your friend.
So that ties into a question that the viewer is asking, Yusuf is asking. I would like to ask Mrs. Kelly if she works with any options models such as Gamma, G-A-M-M-A, and I'm not sure if there's talking about the Greeks here or if there's something called Gamma system or something, or she reads any institutional flow as part of the program.
No, we're really we're looking at, the market as a whole. So we're putting, in terms of our option strategy on its own, we're just going month to month. And when we position, we're looking at what's the current volatility, where are we within the trend, how much time is there to expiration, the basic things that we're looking for. And what we want to do is make sure we're positioned far enough out that we don't take a lot of price pressure. And that if we do, that price pressure isn't going to be so quick and happen so quickly that we can't navigate it, so we have strategies for, different scenarios where we might roll to a further out option, we might just exit, those kind of things. But, so we're looking at, the basics that you would look at for.
Yeah, it's very traditional kind of tried and true approach to options investing, really. Someone else is asking, you mentioned leverage. What is your max leverage you would use on any single trade idea?
So we have an internal leverage calculation that goes into our positioning. And like for our futures, we're looking at the level of, and the options, what is the level of the S&P? For the options is, what strike are we looking at, kind of a thing. And then, we look at, the assets that, we're using, and we, use some form of leverage that can range from, like, say, half of, so we use 1-to-1 often. And I think the highest we really go is like 1.5.
1.5 of what? Of margin or notional or?
Oh, so that's, yeah, there's a different way to look at it. So that's a positioning as compared to the index level. So in terms of based on assets and your margin to equity type of a thing, wow, we've been hanging under 20% for a really long time. I think, in the early stages when we were using the big S&P contracts, in a very volatile environment, margin could get pushed up to like 50%, but that's part of controlling risk as well. So yes. We don't overposition, we don't over leverage. So then if you have clients that want to use their own leverage and they want to do, some level, there's room in there for them to do that. Although we don't spend more than 2 times.
Right, okay, fairly conservative. Very cool. Just a quick spot here for Convergent trading. For those of you who are new, just in case you didn't know what Convergent trading is, I invite you to go to ct.pro/store. Excuse me. Convergent trading offers services to those who strive to trade as a professional. That includes a curated chat room, professional news squawk, so you're in the know, so you could have heard what the FOMC had for us today in the minutes as the market responded very negatively to what we saw. We do webinars, private member webinars on a weekly basis, twice a week or once a week. We distribute our own levels for Ninja, Sierra, Investor RT, Edge Pro X, and various other platforms. We generate market stat reports. These provide tendencies similar to what Kelly's talking about here, where we're constantly monitoring how the market's changing over time, volatility, rotations, the quality of movement, things like that. Of course, this includes the Trade Right program to just get you thinking like a professional, and accountability journals. It's a system by which you enter your trades and how things, your plan, and then compare your plan for the day versus how you actually performed. Again, go to ct.pro/store. Next thing we want to get into is risk management. In the interest of time, I want to keep this somewhat brief, so I'm going to jump into how did you put your strategy together in terms of risk. Now, you described some of this a little bit earlier. What method do you use to define risk for your fund? It sounds like you're deleveraged quite a bit. You're using a small portion of the margin allowable. How does that play out for you in a fund?
So each system has its own predetermined risk, and then they have their own risk systems that are looking at, what's going on with the position at the time, and we're constantly analyzing that. So we're always looking at, where our positions are and whatnot. And then we also have an overall portfolio risk. So, like, just to really kind of make a basic, like for the options portion of the trading, we kind of targeted that we didn't really want our drawdowns in a position to exceed 5%. But our risk systems actually have kept those losses, well under that for, part of it. So, you have kind of a max level. You also have, different factors that show you when a position is, starting to go against you, and then different strategies for addressing that. And so each one has their own set of filters and, risk parameters. And then there's an overall where, where we don't want within a given, time frame to exceed a certain amount.
Okay. And when does it become clear to you that a trade is simply not working and you just need to get out? I'm assuming that as someone who's constantly analyzing and monitoring several strategies within a fund, that you're not going to sit there and say, oh, well, we'll just let it hit our stop. When do you intervene versus just letting it kind of consume the entire risk that you've set out for that particular trade?
Right. Well, take for example, like, March of 2020. We had some option positions on, and, we have our preset stop levels, but you could just see that this was coming down, that, we were in, the whole COVID thing was such a different driver, right? And there was, this huge volatility pumping in. So, we just actually decided to move to the side. We just kind of made the decision that, we weren't going to wait for the stop to hit, kind of a thing. And then we actually sat out to the side for a little bit on all of our positions and just kind of let the market figure itself out, and then waited to get in for our reentry. So there are times where you can just see that, what is happening, your normal signals, like, okay, this is an exhaustion point, there might be a buy entry kind of a thing. You could just see that, there was potential for some continuation there, and we just wanted to get a confirmation that, some of that had played out. So
in that situation, do you wait for green light, green light, green light across the board, or do you, even if you have green lights across the board, do you still wait to get a feel for the market? So there's a kind of an intuitive ingredient, or is it purely systematic where, hey, green light, okay, third green light, we're in, and you just go in, you risk 5% on the position, and off to the races you go? How do you manage such a thing?
We did actually lag in. So we lagged in and just, slowly adjusted our leverage. And then, we actually had delevered quite a bit in the options. So, we waited for a lot of that to play out before we had exposure on both. So what you want, so we're looked at what is our total portfolio risk, and we had potential exposure from continued volatility on both sides. So then we just pulled back on our positioning until we felt sure that it was moving back into normal trading.
Okay. What was the worst trade you've ever been a part of? Where things just did not work out, maybe not a worst case scenario, but pretty close.
I'm not going to talk about 2020 again because we all know what happened there. I would say, like one of the, you always remember the losers, right?
Right. But, given that you're dealing with options, I remember February 2018 was just disastrous for a lot of option funds.
Actually,
how did that go for you?
It wasn't great. No. So this is how these internal systems, and rules help us. So we had actually had an indication that had us delever on our options at the very end of January. So the new options positions that we had on was a low leverage position, further out, that kind of a thing. And then we actually hit a stop right as we got into February. So then we were out. So we didn't have any options exposure that following Tuesday when everything kind of fell apart there. And then we just had on the futures positions, which, then we followed those parameters and traded accordingly. So that month, compared to a lot of option traders, was not horrible for us.
So what is your worst trade?
October of 2008, just, where I'm in an options only program and, short puts and, that it just, we had huge volatility like we had never seen for as long as the VIX had, been tracked. And, just dealing with that, like when to get out and when to just step aside. I know,
Kelly, I might have lost you.
Okay. We didn't do great. It was a great learning lesson in terms of those kind of things. But we also, because we tend to not have over positioned that month was a 10+% drawdown. It could have been so much worse.
Yeah, and it was a lot worse for many, right? Yeah.
And then sometimes you just get that right. But even like January of 16, I remember, we just, we hit 3 stops, like boom, 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 like in a row on different positions. So, when you get stopped out of different systems and like all in a row, it adds up. So, you remember those things when they happen. And then, we just had to wait for the next signal to enter and then move forward and continue with your systems.
Right. Okay. So a quick pivot. Issues relating to execution is an important topic for most traders. Now, you're not managing, a $1 billion fund or anything like that, so you're not having to put on and take off 10,000 contract positions and options or in the S&P futures. But how do you guys put these positions on? Is it a one-click, hey, market order or limit order? Do you have to work positions? Especially imagining the options when you're going way out in terms of expiration, things get pretty thin there. So how does a fund manage the entry and exit of a market that may or may not be thin?
Right. For the options, we usually are using limit orders. We're picking where we feel like our best price opportunity is. Although when you're exiting it, depending on what the situation is, you may use a market order at that time, but you're subject then to the wide spreads. So in that scenario, we're using typically limit orders, but in terms of, like the futures, we pick a level that, or an area or a time where we have an entry. Like, so if we have a signal, a lot of times is telling us, get in at the end of the day. So then we're just picking, a level based on where it's at for that time of the day. So it's pretty, like for the trend following piece, we're just getting in at the time that we're getting the signal kind of a thing, as opposed to saying we want to be in at this specific level. And then for exits, again, depending on what's happening, if we hit a stop, we hit a stop, and then you're just out. But if you see that, it's probably a good time to get out before you take more downward pressure type of a thing, we might work in orders. It's really how much time do you have? What is the volatility? How fast is the market moving? Those kind of things. In terms of, the day trading, a lot of times we're using market orders on those. For entry, more often limit orders, but, we're just using market orders for a lot of our exits.
Do you have to go into anything fancy like an iceberg type of trade or an execution algo to get in and out of a position that is a limit order versus a market stop or a market entry? Is it a person clicking and just getting in at whatever price it is? Is that how you're doing it?
So because of the way the options had, been previously, we actually had been calling right to the floor of the CME with the group that we work with there. So they've been doing a lot of our execution for us still. The day trading can easily be automated. We're talking about doing that and actually have somebody kind of looking at that. And but yeah, so we're working with people on the floor. I mean, it's a little old school still.
Got it. No, I mean, that's what they're there for, to get you the prices you're asking for. The last thing we want to talk about to wrap up here, we're almost out of time, is maintaining a sustainable mindset. Now, you've repeatedly talked about how the market changes and there's a lot to account for, and you're constantly testing and back testing and looking, analyzing volatility, analyzing the levels in the S&P and the options associated. In addition to administering a fund, in addition to probably soliciting for a fund, raising capital, things like that, what are you doing as a professional to maintain a sustainable mindset, to be able to do this almost a 24-hour-a-day job, 6 days a week? How do you make sure that you remain sane through the whole thing?
Well, one of the things is I've always worked with partners. So I'm not the only one that's watching the markets and also having to take calls and handle all the compliance and the day-to-day. I don't know, I guess back in the day when I was, working on the trading desk, I had to write disaster recovery, type procedures. And for me, a backup is really important. So, we have backups built in along the way, but having somebody that you're trading with, it helps in a lot of ways. So you can talk about what you're looking at. We can talk about, what we're seeing, what we might want to test, and somebody might see something that you're not. So that helps. And then, you just have to have faith in your system and know that, your profitability will outpace the losers in the long run, kind of a thing. And you owe it to your clients to, remain steady and calm and logical. And, that's when I end up talking to the most people is when the market is very volatile. You're having to do all these things, watch what's happening, and then that's when you're getting all the phone calls. And I really make it a point to make myself available. I think that's really important because after all, it is their money. It's important to them. So you know, and that's where you have to maintain, you know, and you have to know your systems. You have to know what that you're doing, what you're supposed to be doing according to your risk parameters, and be able to communicate that.
What are you doing for balance, though? I mean, so that keeps you in line with what your job is, but how do you maintain balance, you know, like family time and stuff like that? Do you take time off often, or you know what I mean?
Yeah.
It's an exhausting job to trade or to do anything with the market because it's just relentless. Every day every tenth of a second there's a tick, right? 24 hours a day. So what do you do as a person who's responsible for other people's money to stay grounded, so to speak?
Right. Well, you have to get away once in a while, you know, like, so I, you know, try to, you know, make sure I'm getting some kind of exercise. That was fun during COVID when the gym was closed, but you know, like, you know, where we live, you know, summer's a great time to be outside. I try to get outside as much as I can. And thanks to the advent of the smartphone, I can bring the market with me, or, you know, I know if I'm getting a call or whatever it might be. And there are times when, you know, you can walk away, but that you also have the ability to do what you need to do if you have to. You know, so like in this summer, for instance, you know, I've been trying to get up early, just get a walk in. And then on weekends, you know, I do stuff. You know, Saturday is my day to like get out there, spend it with family, friends, whatever it might be. And then at night, you know, I also just try to, you know, make sure that I'm only really, you know, on it all the time if something's happening, you know, and I have to be watching or whatnot. But again, that's where it's great when you have partners that you work with. So you're not the only one that's responsible for what, you know, is going on. In terms of vacation, can't say that I've had a lot of like really getaway vacations. You know, we've been fortunate enough where, you know, like my parents have a place in Florida and we'll go down there. During COVID, my sister and I went and worked down there for 2 weeks because we thought it was better than being in Wisconsin where it's cold. And it was great because, you know, when the market closed, you know, we went out and golfed, walked, whatever it was that we did. So yeah, you gotta, you know, make sure that you're among the living as well.
Right. So I have a couple of quick questions, but I want to make sure everybody knows that Kelly is available via email. You can reach her right there on your screen at kfarrell@diamondcapitalmgmt.com. She's also on LinkedIn. The link is provided. You can always pause at this portion of the video if you're watching a replay. And of course, we will send you the recording so you can watch the replay if you wish. You can move on to this slide and find Kelly this way. And of course, a lot of information is on diamondcapitalmgmt.com, including the programs. If you're interested in getting more information on the program, you can reach out to Kelly directly. Also, you can reach out to my guys at EdgeClear through edgeclear.com and ask about Kelly. They'll be able to guide you in the right direction as well. Before we head out, I have a couple of questions we haven't hit on. Someone is asking, do you use any software services to help model your portfolio risk scenarios, plan and manage trades? Do you use proprietary software for that?
We're using proprietary software that actually Alan has worked on. That was kind of his background before. So he's been able to systematize more so like the trend following signals and whatnot, but they are not systems that speak to the market. You know, they're not interacting with our trades. So they're giving us the signals and then we're reacting to that and placing trades. At some point, we definitely are planning on programming the trading portion for the short-term day trading stuff, because it can be. The rules are specific enough that we can do that.
Okay. Another question, do you participate in the crypto market at all? Bitcoin or anything?
Not through Diamond Capital Management.
Got it. Okay.
Perhaps on for myself in a different area.
Got it. I think that wraps it up. I want to remind everybody that the performance in a fund is not going to reflect the performance of a day trader. It's a lot more complicated to run a fund. So comparing the performance of a fund to what you can do on a day trading basis is not is apples and peanuts, really. So just look at the perspective of a fund as something that is much more long term. I've come across people who put money in a fund because they saw that the performance is great, and then they don't like what they see in 2 months and pull their money out and run away. And that's not how it's, a fund is supposed to be something that takes a slice of your risk capital and is something you hang on to for a long period of time. So I can always say, well, my prop shop returned, 50% per month on equity. Try to do that with $300 million, So, we're using a tremendous amount of leverage, or try to get the performance on a day trading basis with 100% of exchange margins. What I'm saying is it's a different ballgame. I know most of us are day traders who would be listening to this, so just consider that. I want to really take a moment we don't have any more questions. We covered a lot, and I want to take a moment to really thank you for taking the time out of a super busy schedule, doing what you do, to talk to us today. Thanks for kind of putting yourself in front of the public and showing us and telling us how things are done at Diamond Capital. We appreciate having you on.
It was
Cheers.
fun. Thanks so much. Appreciate it.
Thank you. Take care, everyone.
All right. Bye-bye.
Bye.